So here to help us assess the state of the recovery is Paul Donovan. He's Deputy Head of Global Economics at UBS. Well, welcome, Paul.
Morning.
So I've just been talking to my colleagues Judith and Manis about the stress test. What do you make of what we hear so far?
Well, if what we're hearing so far is accurate, we don't have any stress tests. What we've got are Pangloss tests. This is the best of all best possible worlds. I mean, for goodness sake, a 17% haircut for Greek bonds is what's being reported, and yet the market's pricing in a 60%.
Right.
17% is barely a restructuring of debt. In a stress test scenario, you've got to be looking at something like a 50% haircut. The tests are not going to tell us anything particularly about the health of the banking system. They're far too generic, and they're clearly not stressful. What they're telling us is, how we operate under the best possible scenario.
If that's the case, if they're not rigorous enough, could we see confidence dented even further?
Well, I don't think it's possible to dent confidence that much further in European political processes. I mean, confidence is not terribly high to start off with. I think what you're going to end up with is markets just ignoring this sort of stuff and continuing to assume the worst in some cases and assume optimistic scenarios in others.
What does it mean for the ECB and the EU's credibility?
Well, the ECB, I think, is in a difficult position because the ECB can't recapitalise the Eurozone banking system. Now, the whole point about the stress tests in the States was that although there were flaws in those tests, they come out and recapitalise the banks afterwards. Now, the Spanish government is not really in a position to go out and put 100 billion euros, which is what we think is necessary, into the caja. So you've then got the problem that you come out and say, well, actually, these guys aren't in terribly good health, but never mind, I mean, that's really not going to be helpful for the market. So the ECB is in a very difficult position on this.
Well, you say you think 100 billion is necessary for the Spanish banks. I think the Spanish government said something like 33 billion.
Yes. Slight difference of opinion.
Yeah.
It depends on a lot of the underlying assumptions, but yes, certainly more is required, I think.
Well, let's talk more about this ECB meeting that they've got today. I mean, are you of the opinion that they're going to wait to do anything or say anything until these stress tests are published?
I think they've got to wait. There's a need to keep the powder dry. I mean, if the market does have an adverse reaction, if the market looks at these and says, yeah, I don't think so, then the ECB is going to need to have some kind of policy response.
Are you concerned about interbank lending rates rising in Europe since the withdrawal of these one-year loans from the ECB?
Not terribly. I mean, what's really happening within the Eurozone is you're sort of establishing a two-tier market. That, there's an interbank market which is functioning, and there's a group of banks who are borrowing from the ECB. At this stage, that's not a major concern. What would worry us, of course, is if the interbank market starts to show signs of distress for perhaps some of the better quality names. If you get into the scenario that you had after October 2008, where the interbank market just simply ceases to operate, that then becomes a lot more serious. We're nowhere near that at this stage.
Now, do you think that deflation is a concern for the EU, the Eurozone?
I think it should be. I'm not sure that it is.
Right.
We have with the Bundesbank tradition, Axel Weber and so on.
Yeah.
They're not really looking at deflation as a scenario, and secretly, I think Weber would probably quite like a little bit of deflation. Frankly, I think there are risks, though they're not perhaps that high. I mean, if we look at somewhere like Greece at the moment, I mean, Greece is nowhere near deflation, and that's actually part of the problem.
Right.
The Greek drachma is actually rising in real terms against the euro because they've got an inflation rate which is running at 3 times the Eurozone average. So we're not yet at the stage where we've got widespread deflation. Growth deflation, absolutely. But CPI deflation, we're not quite there yet.
You don't see a lost decade ahead for Europe then, like Japan?
It is a different situation from Japan. The Eurozone banking system has its problems, but it's not like Japan in the early 90s.
Yeah.
There are weaknesses, but we're not at a stage where the banks are failing to intermediate in the economy. There are risks, certainly, that you end into that situation, but I don't think we're quite there.
Let's switch gears and talk about the Bank of England and inflation, because we had a dissenter last time around, Andrew Sentence. He thought that the Bank of England should raise rates because of the bond purchases and the fact that was perhaps stoking inflation. Do you think we're going to see more people on the Bank of England Monetary Policy Committee coming round to that view?
I don't think so, not if they're looking at the data, which I don't think Andrew can be doing. If you look at inflation in the UK, excluding the VAT tax hike, it's going down. Ex-taxes, UK inflation's running 1.2, 1.4%, falling as an inflation rate. Look at the BRC shop price index yesterday, coming down. Talking about price discounting, moderating seasonal food prices. The things which people care about are actually not showing particularly strong inflation pressures away from the tax increase. VAT tax increase this year, VAT tax increase next year. Of course, that raises the headline rate, but the underlying pressures, which is what economists are supposed to care about, they're not really showing much
But you've
problem.
got to admit, $302 billion, that's the size of this bond purchase program. That's got to be causing some sort of inflation.
Well, no, it's not. The demand for cash in the UK has never been this high. This is the point. People are demanding paper money. They want cash. The banking system is sitting on this money. It's not like this money is being pumped out into the economy and everyone is sitting there and holding on to the cash that the Bank of England's been printing. What's happening, of course, is this money's being given to the banks, and the banks are saying, thank you very much, we're just going to shove it under the mattress for a while.
Right.
If it's shoved under the mattress, it doesn't do anything to the economy. It's got no impact.
Speaking of the economy, you've got the government embarking on some very deep spending cuts. How is that going to affect monetary policy, and do you think we're going to see a double dip in the UK?
I don't think we get a double dip. Absolutely not. I think that what we have got is a necessary tightening of fiscal policy, because the thing to say is, well, if the government wasn't tightening fiscal policy, what would the Bank of England be doing? Well, obviously they'd be raising interest rates. Now, most people in the UK care far more about a 1% interest rate increase than they do about a 2.5% VAT increase. I mean, somebody like myself, I've got a mortgage, floating rate mortgage, like any normal person. I've borrowed 5 times my income. 1% increase in interest rates, that's devastating for me.
Right.
As an economist on a very low income, I don't spend a lot of money, so a 2.5% VAT increase, I don't care. The focus is keeping interest rates down, and I think the government, through its aggressive fiscal stance, is going to keep rates down and therefore avoid the disaster scenario, which would be an aggressive monetary tightening.
Fantastic. Paul Donovan from UBS, thank you so much.